Howdy there, folks. Three videos to react to here today in this video. First one is Centauri Funds. Dan Niles says retail investors should go cash, okay? Meaning you should sell your stocks and you should go cash, okay? Gonna watch that, gonna react to that, gonna give my 2 cents on that, okay? Next video I'm gonna react to here is this one. We expect a recession in Q1 2023 from Citi's Kristen Bitterly. So we're gonna watch that one, gonna give my perspective on that. And then, I can't wait for this one. Everybody's favorite bull, Mr. Tom Lee. Oh boy, this sounds almost depressing right off the bat. Like, is Tom Lee going bearish? Is Tom Lee going bearish on us? Oh no, Tom, we're the only, I think, bull we got left on CNBC. Says it's unrealistic for investors to say markets are going straight down. Oh man, that sounds depressing. So first off, it's interesting, right? I think I'm going to make a list and I'm going to check it twice because I don't want to hear any of these folks ever call themselves investors again. This has been a year that I think has exposed like who's real investors and who's traders. And there's nothing wrong with being a trader in the market. But just call yourself a trader. Don't ever call yourself an investor because, what we've heard over the years is don't try to time the market. And then what happens all of a sudden we're in a year that's crashing? Everybody's like, time the market. Hey, you got to get out. Hey, you should go cash. You got to sell your stocks, right? And then what have we heard over all the years? People say, oh man, I can't wait till it crashes. I'm going to be buying stocks. I'm going to be, I'm going to be loading up. Oh man, I can't wait till that. Oh, I wish I was in 2008, 2009. I would have been buying so many stocks and I would have been buying so much real estate in 2010, right? And people say stuff like that. And then you get this actual moment. And it reminds me of like, being in school and there's like a bully in the school, right? And kids can talk tough, like, oh, I would stand up to him, I'd kick his butt. And then the bully comes after them and they're like, oh, no, I don't want any piece of that. That's like the stock market. The stock market's a big, bad bully. And it's just bullying people around. And you're finding out people are just backing down left and right. I want no piece of that, essentially. So it's unfortunate. And, I shared some words inside the private group in the Discord chat. I think it was last night. And I just told folks I just want to say thank you to everybody that's a member in the private group. It means a lot. I have no one to talk to outside the members of the group, literally. Everyone's left the market or doesn't care about stocks anymore, essentially. And this is unfortunate because it happens in every crash. Retail leaves and they usually don't come back for years into the future, if ever. But usually when they do come back, unfortunately, it's usually when the market's all hypey and excited again and everybody's making a ton of money and it's like beautiful and that's usually what happens, right? And it's usually years down the road because even when the market starts to come back and even when people start making money again and things like that, right? People are still deathly afraid of the market because they've been hurt so bad. So they just stay away. They want no piece of it. And it's unfortunate, but that is the way it goes, okay? So let's get into this, guys. Hope you enjoy this as always. By the way, if you're wondering what is this ridiculous hat on my head, I'm sorry, I probably should have explained that before. I don't know. The hat was literally just like next to my work area where I record these videos. So I guess my wife bought like a Freddy Krueger costume. She's going to be Freddy Krueger for Halloween. So, I thought I would just throw on this hat and I don't blame her. I mean, shoot, man, if I was married to me, I'd be Freddy Krueger too, man. Oh boy. Okay. Alrighty, guys, let's jump into this. Hope you enjoyed as always. I appreciate each and every one of you being subscribed to the channel. I think we're going to hit 16,000 subscribers pretty soon here, which is crazy. That's just crazy. That's just insane. So thank you, everybody that's subscribed to the channel. Let's react.
All year that retail investors would be better off in cash, and you were right. Even with the rate of inflation, cash has certainly preserved its value more so than the broader markets. But if you have a longer time horizon now, is now a good time to start nibbling, especially at some of those tech names. We just saw Mike break it down, how we are getting closer to those pre-pandemic peak. What do you think?
Well, there's the long term and the short term. In the short term, I actually believe October will end up being up. And the reason I say that is if you look at it historically, October is up 60% of the time over the last 70 years. Average gain is 1%. But when you go into October with the market down 15% in the prior 9 months, your odds of it being up go up to about 83%, and your average gain is about 3%. And even if you look at so far this month, right, horrible PPI numbers, ugly pre-announcements, and the market's down about 1% so far in October. So you're sort of setting up, and even if you look at some of the action today, Applied Materials, big negative pre-announcement, stock's actually up on the day. You look at Micron Technology, they cut the forward EPS from like 70 cents to like 10 cents for next year. FedEx, right? Massive pre-announcement. EPS goes down by about almost 50% for the next quarter. Nike numbers go down over 20% looking forward. All those stocks are up 6 to 9% from their lows a few weeks ago. So I think this is all signs that in the very, very short term, my belief is that the market rallies. From the long-term perspective, though, as in the tweet I put out this morning, the bottom, I think, is still S&P 3000.
Okay, so first off, very important. He basically says, if you're going to buy short term, then you're okay. So basically he's saying trade the market. That's exactly what he's saying. He says, we're going to be bullish for the next however amount of time, let's call it a few weeks or so, right? That's his opinion there. And he also believes the market's going to 3,000 in terms of S&P 500, which is down considerably from here, right? Something a lot of folks don't take into account is, they see all these numbers, right? And this is important. This is very important because I don't think a lot of these Wall Streeters are putting the pieces together here, at least in my personal opinion, right? Almost no one on Wall Street admits we're in recession, right? But yet they see all these companies' earnings tanking, right? Down 20% and things like that. Now, think about all these earnings this year. Maybe this 2022 is going to be a down earnings year. It's probably pretty realistic, right? Versus obviously last year. So we're going to have a down earnings year in 22. Now, everybody's expecting a down earnings year in 23, right? But now we're going to have much easier comps in 23. So this is something to kind of keep in mind there as far as that goes. So, I think these are all factors that are very, very important, but, it's just interesting to hear somebody saying, you don't want to own the market for the long term, maybe for the very, very short term. That's just usually opposite of what you're usually going to hear out there. So, interesting.
15 multiple on a $200 EPS. So unless you're willing to trade this market on a daily basis and, willing to go to cash, willing to short, you should just stay in cash because 3,000 on the S&P is still a lot lower than where we are today.
All right. So, Dan, you're essentially saying that even if we see...
and I've covered this on the main channel a few times. Even if you go back to like the tech bubble and you go back to the great financial crisis, tons of stocks bottomed and actually started going up considerably before the S&P 500 bottomed. Okay, so this is something very important. In the tech bubble, the Amazon stock, for instance, bottomed a year and a month before the market technically bottomed. Right, in the great financial crisis, countless stocks bottomed way before the S&P 500 bottomed. So, if you're thinking all stocks like bottom on the same day, if it's like it's March of 2023, that's when we're going to bottom this market, or it's December of 2022, or whatever your time horizon is. No, that's not the way this works. There's going to be tons of stocks that are already up considerably from there, essentially. Okay, so I just think that's a very important piece that not a lot of people maybe know about if you haven't really studied the history of the market over time.
A rise in October, that could be another head fake like we saw in the summer. You painted sort of some of the negative data points that we got, but there was a little bit of optimism in today's earnings numbers. You got Delta fuel costs down quarter over quarter. Fastenal spot prices for many inputs began to decline. I think I know what you're going to say, though, and this is acute. You point to the fact that energy and supply chain only accounts for 10% of corporate costs. Wages are worth a lot more. So when do we start to see that? Are you waiting for wages to come down to sort of any sign of a bottom?
You're exactly right, Deirdre. So energy is about 10% of corporate costs, supply chain's another 10%. But wages is 2/3 of corporate costs. And if you look at what determines wages, it's really simple. How many jobs are available? How many people are unemployed? If you look at that, you've got about 10.1 million job openings, and you've got about 5.8 million people unemployed. So you've got 70% more jobs than you have people unemployed. The prior record, as far as we have data, is about 25% more jobs. So you're going to need much more pressure on the employment picture to get that down to a level where you get wages under control. Because it's great looking at gasoline prices or used car.
Before we go further there, I think a gentleman like that, he mentions this massive. There's so many job openings, right? This huge number, right? But where are a lot of those job openings? And I think this is fair. And where are those job openings going to be over the next 6 to 12 months? Well, shoot, every time I ever drive by a fast food place, it says job openings, right? So, if you need to get a low-paying job, a fast food job, a job at a restaurant, things like that, plentiful. But what about the $100,000 a year type jobs, the $150,000 a year type jobs, the $200,000 a year type jobs, right? Those are much harder to come by. Try getting a job at Apple right now, or Meta, or Google. A lot of those companies are pulling real tight, and those are those are the most profitable companies in the world. Try getting a job at Intel right now, or Nvidia, or AMD, or any of these companies. So, I think we're going to have a divergent kind of jobs picture, to be quite frank, where if you need a lower paying job, it's there for you. Let's call it an under 60K a year job, or especially under a 50K a year job. Those jobs are everywhere right now. There's no trouble getting those jobs, right? If you're going up the brackets, that's where it's starting to be an ugly jobs picture. A year ago, very different. A year ago, those sorts of jobs were plentiful as well. The 100, 150K type jobs, you could get those all over the place. Those ones have come down massively, and I mean massively, over this past, let's just call it 9 months or so. And so I think that's something important just to factor in there, where it's like, where are the jobs, right? And where are the jobs going to be at 6 months from now, 12 months from now, versus where they're at right now.
Prices and all this stuff. But at the end of the day, the U.S. economy is 75% services based, and wages is the biggest component of that. And rents, by the way, is the other big piece of inflation, which is 30 to 40%. And that typically peaks out a year and change after home prices peak out. And they just peaked out in March. So you can expect pressure on rents through March of next year. So that's why we have a very big picture view that inflation is going to remain, it's going to come down, but it's going to remain higher than everybody wants through into next year.
Hey, well, Dan, first I want to point out to everybody the Dow has climbed back to almost flat from that dramatically low open. The S&P down 0.5%. The NASDAQ still off by about 1%. But what you said about October and the possibility it ends higher, what does that mean for what we should expect out of earnings season then? Because we're going to get guidance, at least from some folks, for Q4. The dollar has remained pretty strong. How bullish are they going to have to sound in the guide, despite what's happened with inventories, how much they're going to have to comment on discounting and overall weakening consumer demand?
They're going to sound absolutely horrible, John. And I think that's actually what you need. As I said earlier.
That's a big comment, because I think that's a lot of the thought process on Wall Street. They're going to sound absolutely horrible. You heard what he just said there. That's I love that perspective. I'll just be honest, as somebody that I love that perspective, man. Just so negative. They're going to sound horrible, he says. So that puts expectations for this earnings season. Oh my gosh, it puts it on the floor, man. When you got a gentleman like this saying it's going to be horrible, expectations are on the floor for this thing.
Right? Micron, Nike, FedEx, those are about as ugly forward-looking numbers as you can get. Applied Materials last night on their negative pre-announcement. So to some degree, this is going to be what's happened already this year. You've had 6 rallies in the S&P this year that averaged 9% apiece. You're not up 50% this year, right? You're down 25%, but those rallies all occurred for the same reason. Numbers get cut. Investors mistakenly think, oh, this is the bottom, not a bottom. Then they run them up thinking, oh, well, this is a great company. Let me buy Nvidia or AMD or Tesla, or you pick your favorite great company. And I'm not arguing they aren't great companies. But the problem is if the numbers have to keep coming down, they rally for a couple of months, like June to August. If you remember, the S&P was up 17%. And now you've given it all back because numbers continue to come lower. So that's all we're saying is bear market rallies, and we have this on our site, danniles.com, where we've gone back and analyzed them. They happen all the time, right? You had 5 rallies between 18 to 21% in the S&P during the global financial crisis and during the tech bubble break, on your way to losing 49 to 57% of your money. So this is pretty typical. So I think in some ways it's counterintuitive, but the worse the guidance is, the more likely the market is going to mistakenly have another bear market rally. And then you're going to figure out the numbers are still too high when we get to the end of the fourth quarter, and we're going to be back in the soup again. But I think that's how you want to think about this.
So there's
Hey,
definitely
Dan.
a possibility, to be fair there, about numbers being bad, but then they get even worse. And so there's definitely an interesting perspective. The only way, what I'll push back on is this thought process around, like, buy when the coast is clear again. And it's like, when is that? You know what I mean? Because you're not going to really know when the coast is necessarily clear, because maybe companies could all of a sudden feel like things are getting better. So then you think, oh, the coast is clear. And then you get another down move, right? Or maybe it looks really ugly and all of a sudden the market starts moving up and everybody's like, no, you still can't buy. It's really ugly out there. It's just a bear market rally. And then slowly the picture starts to turn better and better. The market continues to rally. And they're like, wait, no, still no. And then the next thing you know, the market rallies even more. And then they're like, okay, now it's time to get in, right? And then it drops more or something. Like there's so many various, and that's why, in my opinion, it's one of the most stressful things to play this whole in and out game of like, oh, I got to buy now. Oh, I got to sell out. Oh, I got to buy back in. It's such a stressful game to me. Everybody's got a different perspective. My perspective is, if I see an asset that is very undervalued, and I've run through my valuation models and I expect net income to be ... number and the risk rewards there, like I've got to buy that stock regardless of if the market's going to go down next month or the month after, whatever that's going to be, up or down or whatever, right? I can't look at assets that are massively undervalued and say I'm not going to buy anything. Just as an investor, a real investor, not a trader, as an investor, it's just, you just don't do that, man. and you're just going to be even more stressed out by trying to play this whole time in and out game, because you're going to make wrong moves both sides. And then you're going to just get into bad habits of trading, right? And we know, like trading is not the way to go. Like, we know these things. We know not to time the market. We know not to go down the trading route, because you're almost always going to significantly underperform the market. And many times you won't even be able to get a positive return. So we know those things. We know those are factual, but yet people fall for it. And it's interesting, right? But 2022 is one of those sorts of markets that puts people into a very uncomfortable feelings. And, you find out where people's loyalties really,
as we pay attention, before CPI this morning, the discussion was largely about UK, right, and their U-turn, if we get that. If there is a dramatic stability event, even if we're not quite back to 3K yet, is that when you start jumping in more aggressively? I always think back to the depths of COVID when Disney shut the parks, and that's when you got long.
You have a great memory, Carl. Yes, actually, the first thing I look at when I wake up in the morning is typically I look at where credit default swaps are on Credit Suisse, Deutsche Bank, what the
When you wake up in the morning, do not wake up and look directly at credit default swaps, okay? I can promise you it's not a healthy lifestyle. Don't do that, okay? Don't do that.
is doing in the UK, not in the US. And those are the things I sort of look at, because the tail risk in my mind is another Lehman type moment, which is I firmly believe you're going to get some kind of big financial institution in big trouble. I don't think it's going to be one of the big banks, but I could see another Archegos type of situation, because so many hedge funds, 60-40 funds, parity funds, whatever you want to call them, they've gotten murdered on their bond positions and gotten crushed on their stock positions. So I think you could see something like that. So that's the tail risk. But there's a lot of other stuff like what's going on in the UK that I'm watching, and Credit Suisse and Deutsche Bank are up this morning. So that's a pretty positive sign as well. So there's the very, very short term where I think it bounces. And, I sent you those notes last night saying, that's what we thought would happen. And then there's the long term, and the long term is what you want to remain deadly focused on, because the Fed's nowhere near finished. And you may get some short-term optimism, but you want to be defensive if you're going to be in stuff. So, we own Walmart because they were up 18% in 2008 with the market down 38%. We're in healthcare, another defensive space. The stuff that isn't defensive, we're getting clobbered in, but we think there's going to be a short-term rally that we're playing for.
Dan, even before this morning's CPI number, there's been concern building, even among Fed policymakers, that the Fed could overshoot, something could crack or even break. And I guess, is that what you're saying? Does that risk increase after this morning's number and the prospect that the Fed can't stop doing what it's doing?
Well, you have to remember, Deirdre, it's how you look at overshoot. They undershot, right? They were a year late in raising rates. They massively screwed this up. So they've got to play catch up, because the problem here is that inflation hits the segment of the society that can least afford it, right? 35% of people don't own homes. So they didn't benefit from the COVID price inflation in home prices. 45% of people don't own stocks. They didn't benefit from all that massive stimulus pumping up meme stocks in the stock market and everything else, crypto. So the Fed has to focus on those people and not people who can afford to invest or own their own homes. And that's what they should have been focused on over a year ago. So I think, that's just going to keep the pressure on things for longer than what, the average investor wants to believe.
Yeah, that's fair. He was mentioning, a Lehman type event there. Oh man, can't wait to get to that one. He's mentioning a Lehman type event, right? In which something happens, something breaks in the financial system that no one really foresaw coming, and it takes the whole market down. Always a possibility. I went through actually today inside the private group in a video. I went through 7 different scenarios that the market's completely unprepared for in 2023. And each of those scenarios would either make the market massively go down or massively going up, because those 7 scenarios are at least somewhat of a possibility, but the market's completely not prepped for those 7 scenarios. So yeah, there's always those things that can come out of nowhere, right? That no one ever really thought was realistic, or this situation could happen. That happens, and it creates a market dynamic that makes a massive swing, right? All right, next one up here. We expect a recession in Q1 of 2023. Okay, and once again, all these Wall Streeters always deny that we're in recession right now, which is just interesting. But yeah.
Know whether either of you were able to hear our earlier conversation, and with the caveat that, number one, it wasn't
It's like all these Wall Streeters, right? Just think about this for a minute. Think about this, man. This really frustrates me. Because all these Wall Streeters, they're like, oh, GDP was negative 2 straight quarters, right? Then they point out, oh, this company's earnings are down 20%. This company's earnings are down 20%. Look at this company's earnings, 20%. All these pre-announcements, right? And then they're like, oh, we're not in a recession. What? What are we talking about here? Well, because there's this massive, because you can get a job at Taco Bell, it's really easy. So we're in no recession? What? Consumer confidence, over the past few months has been the lowest we've ever seen in the history of that survey. AI investor sentiment is about as bearish as you've ever seen since they started doing that in the 80s. We're not in recession? What? What sort of denial? Denial, Dan Niles. What sort of denial are we in the market, right? They literally think that the only way you can justify a recession is if you get high unemployment. There's a lot of other ways of suffering in the economy outside of just unemployment being at ... number. This is bottom line. We've been in very healthy economies in the past that I would feel like are actually far better than right now, where unemployment's been 5-6%. Think about that for a moment, right? So it's just the denial is interesting. That's all I'll call it. And I don't even want to get political.
3%, but it was an incredible sort of reversal, Chris. Do you have a fundamental reason to explain it, and do we need one?
I unfortunately don't have a fundamental reason to explain it. I think any rally that we have will certainly take, but when you're looking at what could happen or what could explain that rally, a lot of it had to have been driven by technicals. We saw some monetization of very large hedges. We saw monetization of short positions, and we saw some very oversold conditions, just generally speaking. I think the question that we have to ask ourselves, though, is that question, has anything fundamentally changed? And the answer is no. The CPI data that we received only emboldens the Fed in terms of essentially locking in a 75 basis point hike in November and certainly increasing the probability of another one in December. So the Fed's in the driver's seat, tight financial conditions. And so it's too early to call an equity bottom here.
What about your thoughts, Victoria?
No, I think there's a lot of information that regards to the positioning going into yesterday's CPI number. And I think that's why we saw such a reversal. We had the expected result after the CPI number. We saw the market come down again based on what we think the Fed is going to do with that data. But again, like was mentioned with Kristen, there were short coverings. I think there was a lot of action going on in the put markets. So there were people coming out of some of those put positionings after they saw the markets go down. So yes, there's not a true fundamental reason. I do think maybe you had some people that had cash on the sidelines deciding to come back into the market at this point in time. You were speaking a little bit earlier about when do you come in. No one wants to really try to chase the market or time the bottom exactly. But when you've had these down days, what we're doing for our clients is going in and nibbling a little bit here and there on names that we like in order to build that position out. So when we do hit the bottom, we're well positioned.
How many that we also, as you heard us talking, I think, Chris, about.
You heard what she just said there. You know, we go in on some of these down days and we nibble a little bit on a few stocks we like, right? The issue Wall Street has in a downtrending market like this is if they go buy, let's use Netflix stock as an example. They go buy Netflix at 230. They really like Netflix, right? Netflix goes down to 190. Their clients are like, why did you start buying that stock? You lost $40 a share, right? So that's the issue they have. In a bull market, right, it's kind of like, why aren't you buying more aggressively? That, if anything, a fund manager has to answer that, right? But in a down market, they're scared because they're like, if I go buy something and everything keeps downtrending, you know, my clients are going to be looking at me saying, why are you buying now? You're throwing our money into this fireplace and it just keeps burning. What are you doing here? Aren't you supposed to be smarter than this, more sophisticated than this? Would you think the market was going to bottom? It didn't bottom, right? So that's why they're all so scared to take a leap of faith out there, because they all understand, you know, the leap of faith for them doesn't really make that much sense until they're forced, because momentum starts to build from other pockets, right? And those other pockets, the market starts moving a certain way, and then they have to start jumping on. And as one domino starts, you know, going this way, another one, and it starts this kind of like compounding effect in the market. I just think that's important to understand as a retail investor out there, like how Wall Street really works and how they kind of think about these things.
Maximum potential downside from here, timing the markets, any maximum potential downside is just a probability. Nobody knows. I guess we could go down more than 20%. We could go down less than 20%. Are you smart enough to get that last 10% move and buy right at the bottom, or is it time to buy some and then if it goes down, buy some more in names that you like, that you think could benefit in whatever environment we're going to be in?
You know,
I think
it's funny. I used to really dislike this guy. He was the guy I disliked the most. That was like a CNBC anchor type guy. And I got to say, over the past few months, he's slowly starting to win me over. Like some of his questions, like that's a great question. He's talking about, you're smart enough to time this market, right? I appreciate that. I've just been impressed with kind of the way he's turned around, at least in my opinion, and he's becoming an ally. So I'm starting to like that.
one thing is that market timing is next to impossible. So this idea that anyone is going to get that right is just a loser's game, quite frankly. And look at what happened yesterday. So the truth of it is the worst days in the market are followed by the best days in the market. And if you're out of the market, just for on average, the two best trading days of each year, you reduce your per annum return by upwards of 80%. It's actually around 9.5 percentage points. So we don't advise market.
Wow. That's incredible. I want to play that one more time for you guys. You need to hear that one and remember this little clip here, okay?
The market, just for on average, the two best trading days of each year, you reduce your per annum return by upwards of 80%. It's actually around 9.5 percentage points. So we don't advise market timing. I think the real question right now, though, is this debate between are we in a recessionary bear market or are we in a non-recessionary bear market? A non-recessionary bear market, we've done most of the work. This 25% down in U.S. equities, we're already there. Those are the averages that we see in non-recessionary bear markets. In recessionary bear markets, you can see declines exceeding 30% and closer to 35%. And our base case right now is actually to expect a recession starting in Q1 of next year. So we are invested in the market, but we're definitely defensive and positioned in quality.
Victoria, same notion here?
Yeah, very similar in the sense that you want to focus with all the volatility that's going on, and we think you're going to continue to see that volatility because, look, no one knows for sure what the path of central banks is going to be. Yes, we anticipate the Fed will now do 75 in the November meeting, probably 50, maybe 75 in December, but I think there's also a huge question as to what other central banks are going to do. How far are they going to push the limit, which is going to fold through into the dollar? It's going to fold through then into the earnings for these multinationals. I think earnings could be a huge component for us. Obviously, we start with the banks today, but we've seen expectations come down over 6% this quarter for earnings expectations. So the question is the bar low enough to where numbers actually beat expectations? If they do, we could see another rally in the market. So I think you need to have a little bit of cyclicality in your portfolio to take advantage of those, but still have some defense because we're not sure that we've hit the bottom, as we mentioned a moment ago. So you need to be in a balanced portfolio with some maybe healthcare names, some insurance names, but also some retail names or some cyclicality in there to take advantage of moves.
So it's interesting that previous woman there, she mentioned something very interesting. And this is how a lot of Wall Streeters speak, right? They say, we're positioned in quality, she says, right? What is quality? It's a very subjective comment, right? I'm in quality stocks. What is a quality stock? Does that mean you're in stocks that have been performing pretty well in the market in terms of their stock price? Because that's what some of these Wall Streeters consider quality. Well, just because the stock's been holding up well does not mean it's going to continue to hold up well. Also doesn't mean the business underlying fundamentals are necessarily great, right? Doesn't mean it's automatically quality. Is it because it produced a lot of cash flow? Is that a quality company? Well, I know a lot of companies that create tremendous cash flow, and they're not quality. They're just historical business models that kind of serve a purpose out there in the market, right? But I wouldn't call them necessarily a quality stock. Is Apple stock a quality stock? Okay, let's say you feel like it's quality. What if it falls 20%? Is it still quality at that point in time? Because some investors would say then it's not quality, right? Because the stock price has fallen. So these are some factors to kind of keep in mind that, I hate it when they say, oh, we're in quality. So what is quality? Just because you own it doesn't mean it's quality, right? Alrighty, next one up here. It's unrealistic for investors to say markets are going straight down, says FundStrat's Tom Lee, everybody's favorite bull. Alrighty, let's get into this one.
Talk frequently. We have a huddle and we spend a lot of time in each other's offices talking about markets. Mark's view does reflect how poorly technicals are. I mean, price is the arbiter, and the market's been in an ugly downtrend, which is what Mark's speaking to. But price can change if fundamentals change. And I think in between now and year end, as much as investors are glum and pessimistic, there are things that present themselves as things that can change how price reacts. I mean, I think there's still a growing gap between what is apparent in terms of inflationary leading indicators, whether it's commodities, job openings, home price, market rent for new properties, and how it shows up in the hard data. Now, granted, the Fed is not trusting forecasts, so they rely on the hard data, but that gap is still growing. And the second is there's a lot of geopolitical risks around oil and energy prices, and so much of the inflation and the surge and the change in expectations have hinged on oil, which means if we have any resolution on either the war front or on oil supply, I mean, I think it's been kind of interesting that OPEC announced a pretty big production cut and oil has barely increased. I think that just tells you that as much as energy is still a wild card and investors are worried about it, I don't know if it's as much an upside skew as people think. But those two represent pretty big potential game changers for how people view market direction.
My understanding. Yeah, a lot of people have been very, very bullish on crude, and just hasn't performed basically since summertime. Early summer, crude peaked, and then ever since then, it's just kind of been in a vicious downtrend. It gets you a little excited for a bit if you're an actual crude investor, right, or you own the oil stocks, and then it just falls back down, and it's like, okay, are we ever going to make progress? The problem is we're going into wintertime. Usually crude doesn't do very well for the most part in wintertime. Like, we had a kind of a hype cycle almost building in the crude market, and that was going into summertime and revenge travel summer and all those sorts of things, right? And that's long in the past now at this point in time.
But I still have a hard time. It's almost like the play caller and the quarterback are not on the same page, right? bounces will likely prove short-lived. That's from your chief technician. Do you disagree with that?
Again, Scott, it's time frames. I wouldn't say I'm disagreeing with Mark, but
Tom, he says that he basically says we're going to go back to the lows before a pullback back down to the lows
actually,
gets
Scott,
underway.
Just to be clear, if you read the complete note, that's not true. He actually lays out different paths, but the path that's being read there is one of the directions. So I would just say,
boom.
It is actually a lot more balanced than what you're describing.
Oh, I'm just quoting. Bounces will likely prove short-lived and might not exceed 38.50 before a pullback back down to lows gets underway. I mean,
it's in the same note that talks about S&P potentially a path towards 4,300 as well. So again, I'm just saying that within that same note, there are multiple paths, but you're just highlighting one of the paths.
I want you to react to another a comment that I saw from Stephen Geiger. He's a fixed income analyst at Nomura, and he looks at that reversal yesterday, to which you suggest it was bullish.
I never really see the judge get checked like that. Oh, man, he got checked there. Woo.
He says, and I quote, "Yesterday was incredibly bearish in my view, even though most think bullish. That massive reversal took out tons of hedges, puts were closed, bears were purged, opens the door for a much bigger decline in the immediate term." What's your reaction to that, Tom?
Scott, I mean, that's a trading comment, and you know how markets trade in the next day or two or a couple weeks. I wouldn't disagree with those points, but to me, again, I think that there are potential fundamental positive catalysts between now and year end. And so I know that there's price and momentum's negative, but it doesn't mean that that's going to necessarily govern what markets do the rest of the year. It's the same reason people can overlay charts of today versus 2008 and sort of treat that as canon, and that's the direction markets are going. But of course, that's not the only overlay one can do. So Scott, I'd say there's positioning and then there's technicals, but then there's also fundamentals and macro. So as much as investors are betting that it's only going to be technicals or positioning that matter, there are other factors that could drive markets.
It's fair.
Tom, look, I've asked you a bunch of those questions regarding you and Mark, and I know you frankly, you sound exasperated with me, but there are a lot of our viewers who are exasperated with you. And the fact that you have such a lofty price target, despite what seems to be blaring in front of all of us, that there's no way to reach some of those lofty levels because of the significant issues that are in front.
This is getting feisty. Oh my gosh. I was not prepared for this. What?
I'll give you the last word. I'm happy to do that. But how do you square that? Because when we have you on and you continue to make these bullish cases in the face of short-lived reversals that seem to be nothing more than bear market bounces, it leaves some people questioning whether they should listen to the advice or not.
Okay, hold on. Before he answers that, okay? First off, they have these bears that go on, all the time and say, oh, the market's going down in past years, right? And these folks go on and they say, this stock's going to crash, this stock's, and many times it doesn't happen, and they don't have to come on and answer all these questions about like, hey, why were you wrong about the market going down, and, all these people are mad at you and things like that. I've never heard one of those people, the Peter Schiff type people that have to answer this, right? Who are wrong like 8 out of 10 years or 9 out of 10 years, and then they get their 1 year and it's like, whoa, put them on a pedestal. It's like, what is this all about, man? So I just want to stick up for Tom Lee in that situation.
That's fair, Scott. I mean, the market's endured a lot of damage in the past month. It's going to be difficult because there is a time window here between now and year end. But at the same time, let's say that our targets are unrealistic, which it is. I also think it's also unrealistic for investors to say that markets go straight down. So, it's been tough. It's been a tough year. Unfortunately, I kind of wish markets were performing better, but we're in a tough situation with inflation, and that's been a pretty tough monster to slay.
It's true.
Yeah, understood. Tom, I appreciate it. I appreciate you coming on and having the conversation. I always do. It's Tom Lee, fund strat.
All right, that was a little juicy there at the end. I appreciated that one. So yeah, I hope you guys enjoyed this reaction video. As always, I appreciate everybody that's subscribed to the channel. I think we're gonna hit 16,000 plus subscribers very soon here. So thank you for everybody that subscribed to the channel. Hope you enjoyed today's video. It's a beast of a video. Holy smokes, almost 40 minutes. Much love as always. If you're looking to join the private stock group, the private Discord chat, check out pinned comment down there, and have a great day.